All right, welcome to my fourth lecture here. Today, first of all, I would like to know where are all the others. There are much more people registered for the course than are attending, obviously, so which is interesting to notice. Then I would like to welcome my friend as well. We have today a guest here. He studied international business. He has a master's degree in international business from the University of Tampere and finished a couple of weeks ago his second master's degree in positive psychology. And it's my friend Tony, and he is now today here in order to investigate my lecture. And afterwards he will ask me some questions. So welcome and enjoy. So the paper that we will discuss today is entitled A 5-Factor Asset Pricing Model from Fama and French. So we talked 2 lectures ago. We were talking about principal component analysis. So assume we have a huge universe of stocks, of assets. And like in the US, we have like 20,000, 25,000 stocks available. And we would like to know what are the key drivers or the core drivers of stock returns. And we could use, we were talking about principal component analysis, how we can employ that mechanical method in order to extract basically the core drivers that span the whole asset universe. And let's say we have 4 key drivers, four eigenvalues in our covariance matrix of this 25,000 stocks. That means we can basically reduce the dimension of these 20,000 or 25,000 assets to 4 orthogonal assets or risk factors in this case that basically describe the evolution of all these 25,000 stocks as a linear combination of these 4 orthogonal time series or assets. This is what we can do. The problem is we don't know these factors. It's mechanically generated given the data. It's a plain mechanical tool that we use in order to break down the dimension of our 25,000 stocks or so. So people do that sometimes, but the thing is, we don't know these factors, and it's an ex post analysis. So you have to have the data already in order to extract these orthogonal factors out of this data set. And you can do the same analysis for any data set. We operating here with stocks. You can do it I told you, for currencies that it has been done already. And we figured out, and there's a paper from Lustig, a 2011 paper, and they figured out that the first 2 principal components of the largest eigenvalues of the covariance matrix of currencies are basically the dollar factor and the carry risk factor. So these 2 factors that you span or explain like 95% of the covariance matrix associated with currencies. So since we don't know these factors, in finance theory, Sharp came up with the CAP-M, so he derived the capital asset pricing model. And basically the idea is basically that the market factor, which is the optimal portfolio, the market portfolio, prices basically all available assets. In our case, stocks. So the evolution of stock returns, of excess stock returns, should be explained fully by the sensitivity against the market factor. So, and then people came up with a test to test this model, to take it to the data, run OLS regressions, and then the intercept basically is the part of the return unexplained by the loading against the market risk. Now that's the idea of the CAP, and there were papers or research has shown that the CAP-M is pretty poor in explaining the cross-section of stock returns, since the alphas imply that this model cannot price those assets. Therefore, people came up with other pricing models For instance, in the 93 papers, Fama and French came up with the three-factor model, which all of us know, where they basically add to the market factor the S&B factor, where our S&B denotes the zero-cost portfolio that is long in short stocks and short in big stocks, and also the HML factor. So we have a beta loading, a sensitivity as well against the HML factor. Yeah. And in their paper, in the 93 paper, they have shown, or they could show, that their three-factor model basically prices or describes the cross-section of assets or stock returns much better than the CAPM alone. So then we have seen 2 lectures ago, last week, the Novimax paper, where he basically suggests another asset pricing model where he basically neglects the size factor here. We have the value factor, the HML factor, but industry adjusted, and he adds the momentum factor, industry adjusted, and also the profitability factor. Yeah. This is what we have discussed last week. Now the Fama and French 5-factor model, they built, or their model is built upon the earlier 3-factor model, and they add 2 additional factors. Yeah. Which is the profitability factor, robust minus weak, but we will talk about that later, from what they grabbed basically from the Novimax paper. And then they add in another factor, which is the investment factor, CMA, conservative minus aggressive. And of course, as we have the regression, we add here an error term. Yeah. That's basically what the paper is all about. And then they take the model to the data using different sets of test assets, and then using the GRS test, which is in essence a test of the intercepts of the mispricing, of the systematic mispricing, in order to show that their 5-factor model does a better job compared to the earlier 3-factor model, which is often used as benchmark model in asset pricing research. Yeah? Nowadays, it's the 5-factor model, of course, but until this point in time, it was still the 3-factor model that was dominating asset pricing research. So, how do they motivate that choice? I told you earlier, in the 1993 paper, they didn't really come up with a theoretical explanation for why to choose the value factor and the size factor. It just happened to be like that, since these risk factors, or these proxies for risk, they explain somewhat the cross-section evolution of stock returns. Yeah. But in their 5-factor model, in their new paper, I told you already when we were talking about the Novimax paper that we will come to the equation from the Novimax paper, that will come to that back again, and this is what you see here. The second equation is exactly the same like in the Novimax paper. So they use the same valuation model, which is derived from the discount cash flow model, yeah, which is in equation 1 in that paper. So if we have this equation, I put it here on the whiteboard, and you divide it simply by BT, which is the book value time T, then you end up with the third equation here. So of course, any equation, you can do the same operation on both sides of the equation, and that's exactly what they did here. So, and then you can ask, okay, given this model is true, and given we are in an equilibrium, in an asset market equilibrium, how does the return, which is the expected return in this case, need to adjust? For instance, if M decreases, M is the market value or the capitalization of stock I. BT is the book value. So if M decreases, means that the book to market ratio, once again, if M decreases, means that the book to market ratio increases. So now you can ask, how does the left-hand side, given that we keep everything else constant and only R is varying, only R can adjust. So how does R need to adjust in order so that the equation is in equilibrium again? Any idea? Do you have any idea? So if M increases, it means that the left-hand side here becomes smaller. Yeah? So how does R have to change so that the upper part, the denominator here of the right-hand side of the equation, becomes smaller? That's now the question. If only R can adjust, given that all else is being kept equal. So R needs to increase, right? If R increases, and we discount basically what is here in the upper part of the term, R needs to increase to make this expression here smaller, so that we have equilibrium again in this equation. So if M decreases, which means in essence that the book to market ratio increases, then R must respond positively. That's why value stocks generate higher returns than growth stocks. I asked this question a couple of times in exams as well. Because it's pretty simple, it's obvious, you know, I mean, no big deal. So in the same manner, you can ask, how does R need to adjust when the earnings, when the profitability, which is given by Y, if Y increases, how does R need to respond so that the equation is in equilibrium if other else is kept equal? And we were talking about it last week. It's the same thing. It's the same argumentation. So that the term here is equal, and if Y increases, then of course R needs to increase as well. So that we have the equilibrium again. That's why stocks that have a higher profitability are associated with higher expected returns. And then finally, as we have not only the profitability factor, as in the Novimarks paper, but we have also this investment factor here, CMA, conservative minus aggressive, we can next ask or wonder, okay, how does R need to adjust if this guy here increases? Which is in essence the change in book value. If the change in book value increases, means that we have asset growth. It's the asset growth effect. So how does this guy here need to adjust if this increases? If this increases, means that this overall expression here decreases. This becomes smaller. When this increases, this expression here becomes smaller. So how does R need to adjust so that we have equilibrium again? So of course R needs to decrease, right? So that's the asset growth effect. That's why stocks that have a lower asset growth generate higher returns than those who have a higher asset growth. It's exactly the other way around to the book to market ratio effect. Yeah? Any questions so far? Is that clear to everybody? Good. that's the motivation, or that's basically the idea behind that paper. We have this valuation model, and then we can wonder, okay, how are changes in these variables here associated with expected returns? And based upon this idea, we can form portfolios, zero-cost portfolios, and use them as risk factors in our asset pricing model. And then we can test, of course, okay, how well does our model perform? That's the idea of that paper. I also recommend you to watch the keynote speech from Fama. Actually, last year, as far as I remember, I showed the keynote speech because Fama got the Nobel Prize a couple of years ago in economics. And last year, I was showing the keynote speech. It takes about 30 minutes here in class. The problem is that I lose this time if I show you this speech, which might be entertaining for you, for sure. But it takes away the time from that paper. So there's a trade-off, okay? I mean, the more I entertain you, the less you learn, I guess. So, but I recommend you that you watch it at home, so then you get basically, you see basically the red line much better, you know, what's going on here. And he's explaining very well how he came up with the idea and, you know, all the research problems on the way, and so on and so forth. So, of course, there's a story behind all that, behind all this research. And I told you earlier, asset pricing is a huge area of finance research and probably even the most important one. And, of course, everybody can have an opinion about that. My colleagues maybe have a different opinion on that. That's, of course, possible. But facing the facts, you know, the Nobel Prize has been given twice for asset pricing research, to William Sharpe and to Fama a couple of years ago. And if you read the top 3 journals in finance, the Journal of Finance, the Review of Financial Studies, and the Journal of Financial Economics, there are a lot of paper dealing with asset pricing research. Yeah? So it's obviously a very important, you can interfere, it is a very important and probably the cornerstone of finance. Yeah? So, and if people don't want to do research in asset pricing, well, that's fine. And you hear this, sometimes you hear these voices, you know, then telling you, okay, this field of research is very competitive. Yeah, well, I mean, sometimes you have to compete in order to win. So, I mean, if you don't dare, you know, the higher the risk, the higher the return. And it's the same in finance research, you know, the same in any kind of research. You know, sometimes you have to take risks, and sometimes you have to take the risk of failure in order to make it. Yeah. So, let's move on here. Table 1 is the first interesting table. Yeah. So the interesting variables are, of course, those that are new, which is the profitability factor and the investment factor, and they also report portfolios sorted by book-to-market ratio. Yeah? So in panel A, they use the whole NYSE stock universe and divide it into 25 portfolio groups from small to big stocks and from low to high book-to-market ratio. That's nothing new. That's what we have seen already many times. Okay, this part of the table is not new. And what you see here, and this is what you should actually immediately be able to observe, that we have a spread here going on. As we move from, irrespective of the profitability group, book-to-market ratio group, the spread is increasing as we move from big to small stocks. So reported are, of course, the average returns, because this is what we are interested in. We're interested in returns. So we want to earn money. So the spread is increasing as we move from big to small stocks. And this is true for group 2, 3, 4, and 5, especially for value stocks here. There's a strong size effect as we move from big to small stocks. So the smaller stocks generate a higher average return than big stocks, but not for this low book-to-market ratio group. So for growth stocks, here's something weird going on. There's no spread. And this is something what you should also be able to figure out immediately. You should be able to figure out patterns. Patterns in this case in returns. In panel B, they do something similar, but they again sort the whole universe of stocks into 25 groups, but this time from small to big stocks and from low to high profitability, as you see here in panel B. And again, here everything is hunky-dory, as we see. As we move from big to small stocks, there's a spread for all of these profitability groups. Smaller stocks tend to generate higher returns, average returns, than big stocks. So here's nothing weird going on. It's obvious. Yeah? In panel C, again, they use the whole universe of stocks, of NYSE stocks, and sort it again into 25 portfolios, and this time from small to big stocks and from conservative to aggressive invested stocks. So from stocks that have a high asset growth to stocks that have a low asset growth. And again, we see as we move from big to small stocks, there's a spread for the first 4 portfolios at least. The spread is increasing from big to small stocks. This is also what we would have expected, but not for the last group here. For those firms that are aggressively invested, which is the group number 5, high investment stocks, they have a large asset growth going on here. What we see, there's no spread, or it's in the wrong direction. So there's, again, something weird going on here. So this is what you should be able to identify as well. And then we can, you might ask, okay, why is that? Well, one explanation is, in all of these 3 panels, we only control for 2 dimensions. We have the size dimension and then the other dimension, like in panel A, book-to-market ratio. But we do not control for operating profitability, or neither do we control for investment. So the stocks are polluted. And the same is true for panel B and panel C. Panel B doesn't control for book-to-market ratio, and neither for investment. So these stocks here are somewhat polluted with other factors that are not controlled for. So what you can do in order to control for instance, for investments, operating profitability, and value, what you could do is, or what some of you might learn in my MATLAB course later, if you choose it at least, you could code, for instance, you have, let's say, you have a for loop, and then you code a condition, and then you say, okay, all stocks that are big, that should get a value of 1, and otherwise they should get a value of 0. So then you code a binary dummy that has, if you have the 25,000 stocks, then this is a 1 by 25,000 row vector, and then you go through all the stocks in your stock universe for each point in time. So we start at t is 1, and then it gives you basically a value of 1 if we have a big stock, if the stock fulfills the certain conditions that we have coded here, and a 0 otherwise. So maybe we have here the first couple of stocks are big stocks, then the others get 0, then we have a big stock again, 0, 0, and so on and so forth. So then you have the second condition. Let's say we want to have all stocks that are high investment stocks. Okay, give me those stocks should get a 1, otherwise they should get a 0. Then we would go through all of the stocks in our universe, and again we would have a binary vector. Which gives us the stocks that are in line with our condition. So, and we can have even more conditions here, and then we can construct a vector that multiplies like the first element in all of these vectors, which means that if we have then a 1 here, like here for instance, that means that this stock in this position fulfills all of these criteria. Otherwise, they would get a 0. That's a very simple way how we can code that. And by this, basically, we would control for all of these effects, and our vector would indicate us where are the stocks that fulfill all of these conditions. Yeah, very simple. Very simple. But the problem is, if we have 5 or 6 conditions, it could be that there are not so many stocks that fulfill actually all the criteria. And then you have a problem. Because then you have a portfolio that may be not so well diversified. And then you can ask, okay, what inference you can then actually make? Not much. Okay? That's a little bit the problem here. And that's also what they actually explain later on in the paper. But that's the problem with this table 1 here. So everything is hunky-dory, but there are these 2 groups where something strange is going on. And one explanation is, okay, probably because these portfolios here are somewhat polluted, because we do not control for all of these effects. Then on table 3, if we move a little bit lower here, below the table, they explain how the factors are constructed. Yeah? So SMB is nothing new, we know that already. HML is nothing new either, we know that as well. RMW, this is basically how they define the profitability factor. Like in the Novimax paper, it's pretty much the same thing. Yeah? It's a portfolio that invests in stocks that have a high profitability and is short on stocks that have a low profitability. And the spread, as we have seen in the Novimax paper, is around 0.3, 0.4, 0.5, depending on the model specification. And then we have also the CMA factor, which means CMA means conservative minus aggressive. RMW means robust minus weak. So profitability and investment factor. So conservative means that these stocks, like we see here in this equation, they have a low asset growth in the period from t-2, between t-2 and t-1, using accounting data. So you look in the balance sheet of each company, you compare, okay, what are the total assets at time t-1, and take the difference between t-1 and t-2 and t-1 divided by t-2. That is the growth in total assets. So, and then you buy those stocks that have the lowest growth given this period in total assets, and you finance this position by shorting stocks that have the highest asset growth in this time period. It's lagged. So you use basically old accounting data. And now you may wonder, okay, why can you do that? Well, asset growth, there's a paper from 2009 in the Journal of Finance from Koppa et al. And they report actually first this asset growth anomaly. And they figure out that this asset growth effect is highly autocorrelated. So those stocks or those companies that had a high asset growth in a previous period, they tend to have a high asset growth even in the next period, and so on and so forth. That's why you can do that. Then in page number 3, also important, they argue quite clearly that all of these factors, the investment factor, the profitability factor, and so on and so forth, these factors are not capturing the actual risk, but they are proxies for risk. They are proxies for some underlying source of risk. What does that mean? Okay. Has any one of you heard about the critic of the CAPM? Now we are back in undergraduate studies, okay? We have the risk and return dimension. We have the whole universe of stocks. And then, you know, from basic finance, There's this efficient frontier that gives you all these combinations, these combinations of optimal portfolios, right? Then you maximize the risk-return relationship, and you end up with the market portfolio, which is probably here. Just the highest slope. Yeah? What we also remember from basic finance is, okay, we would not invest into portfolios that are here, okay? Because they have, for each given level of risk, they would generate a lower rate of return. So don't do that, because that's down. So what's the problem with the CAPM, with the market factor? For instance, if you download the data from the Fama and French website, you will get the crisp return. Other papers might use the S&P 500 as a proxy for the market factor and subtract, of course, the risk-free rate. What would you use in Finland? Okay, most of you are probably not from Finland. So then I can tell you what we in Finland would use. We Finns, we would use the OMX25, right? And we would subtract the risk-free rate. But what's the problem with this approach? Is the OMX25, or let's say if we are back in the US, the S&P 500, is this really the market? Is it really the market portfolio? So what you can do is you can use a huge time series of stocks, and then you can run this optimization, this Markowitz portfolio optimization procedure, and then you will figure out that the ex post portfolio has a higher Sharpe ratio than the market factor. So the market factor that we use as proxy is somewhere here. This is our proxy for the market factor. It's not the real market factor. The market factor is here. That's the market factor. But our proxy has a lower Sharpe ratio than the actual market factor, ex post. The problem is we don't know the market factor, only ex post, but not ex ante. But if we do this regression here, we use as a proxy something like that we assume could be the market factor. And this is, for instance, the value, like evaluated return index, S&P 500, OMX25, and our stock universe in Finland. Yeah, but the problem is that the Sharpe ratio is lower, so the return between the actual ex post optimal portfolio, market portfolio, and the average return of our market proxy is lower. Delta R, which is the return difference. So what do we know from basic econometrics? If we have a measurement error in variables problem. Have you heard about that? Error in variables problem. So if this guy here has a measurement error, like here, like we see here, of delta R, and we run an OLS regression, we know in OLS regression, this guy here is always, our residuals are always 0. So let's assume that this model is true. And if we would include the intercept here, and we would run this model, and we would use the market factor, this intercept would be statistically not be different from 0. Okay? You remember that from last time. We did it many times now. We now have this distribution, and if we test the parameter, a point estimate, then we assume under the null hypothesis that it's 0, and we test it against unequal to 0 or larger than 0, depending on our initial assumption. And once the point estimate is between these two critical values here, then we can say, okay, on a 5% level, we cannot reject the null hypothesis that this point estimate is statistically 0. So if we use the market factor and the cap M would be true, this guy would be 0, according to our theory, okay? But since we use a market factor that has a systematic error here, a systematic delta, and if you run OLS regression, it means that the OLS will compensate for that error, and this guy here will be positive. This guy here will be positive in order to compensate for this measurement error of our proxy. So we cannot test the cap M because we don't know the market factor. Huh? So, and now this is one problem. Okay, now they state, okay, all of these guys are proxies. None of them is actually real risk factor. All of them are like proxies. So, but then we have this problem here again. Actually, even though we would run the asset pricing test and we will check these errors here, it doesn't tell us anything actually. Yeah? Even though they are larger than 0, it can just imply that we have the wrong factors here. But it doesn't necessarily mean that the model is wrong. Okay? It's basic econometrics. Nothing fancy. So that's the general problem with this asset pricing test, okay? Any questions?
Wasn't the CAPM corrected for this survivorship bias in the US? And wasn't it more accurate after the correction? So it was found in the beginning that, was it that because it's the US stock market is so survivor based, it survives, and then other stock markets are not so. For example, they go out of the markets, and that was the reason why the CAPM was not able to explain. And then the author of the CAPM corrected for the survivorship bias, and then it became significant again. Wasn't that the reason why?
I have not heard about that, to be honest. You're welcome to give me that paper, or link to that paper.
Yeah, I think it was the author of the CAPM, I don't remember his name, but I think he corrected it himself.
Okay.
Yeah, I found that it was way more accurate after.
Well, there are many different modifications of that CAPM model, but of course the key problem is here in the original framework. The CAPM is a 2-period model. You know, we have T0 and T1.
Yeah.
But if you run this regression here, it's a multi-period model. So that's actually the wrong model, but people use it anyways as the benchmark model. But that's actually wrong. But people do it anyways. And then what you can then do is you can say, okay, you can somehow make it a time-varying model and make different changes, mechanical changes. This is what people have been trying to do over and over again. And of course, the more fancy changes you do, the more likely it is to have a better data fit. But it's just data fitting. Okay? You can do this with any model, you know. The more you can have a second equation here, and you can say, okay, the beta may be time-varying and be explained by other factors, and you can put this second equation in the first equation, and then you run a state space model, for instance. You can do many things. Yeah. Kalman filter, there are many possibilities, but all this is basically, how to say, it's sort of engineering, you know, data engineering. Of course, this is what people do, but this doesn't necessarily mean that it makes the initial assumption better, you know. All right. So on table 4, they discuss different kinds of issues. Maybe not so important for us, I guess. Of course, I discussed a little bit already with you, okay, if we sort on too many conditions at the same time, the portfolios can be poorly diversified. So this is what they write here, basically, or what they point out on this page. And you have, this is what we have done here. This is like independent sorts. You can also estimate, you can use dependent sorts, which is a different methodology, what we will not cover here, though. and so on and so forth. So always different possibilities to tackle like the same problem. You can have different viewpoints, and you can go different ways to move towards the goal. So, but as we already said in table 1, the problem was that these portfolios were somewhat polluted because they didn't control for all of these effects. So in table 2, they do triple sorts. So they use the whole stock universe and divide it into, first of all, into 2 groups, into big stocks and small stocks, two big groups. And then they do, for each, that they build subgroups. In panel A, you see, for instance, stocks that are small, and then you take these small stocks and sort them by book-to-market ratio and from low to high profitability. This is what you see in panel A on the left-hand side. And then you see there's a spread as we move from low to high operating profitability for all of the book-to-market ratio groups. This is also what you would have expected. So there's nothing weird going on. There's a clear spread for all of the portfolio groups. The same is true in panel B. If we sort now, if we have small stocks that we sort with respect to from low to high investment and from low to high book-to-market ratio, there we see a spread, increasing spread as we move from high to low investment stocks. Exactly what we would have expected. And this is true for all of the book-to-market ratio groups. So we see from table 2, once we break down the correlation, so we do that basically in order to break down the correlation. And we see once we do that, the pattern is clearer. So the spreads move in the right direction. And at home, you can think about the right-hand side, the big stocks. In section 4, they're talking about how to construct those factors. And what they do is basically, they call it 2x3 sorts. So they have here small stocks and big stocks. Then they have 3 groups of book-to-market ratio from low I will just write low, medium, and high book-to-market ratio. So, and then they do the same again. They take the whole universe of stocks, divide it into small and big stocks, and then they take low investment, medium investment, and high investment. And then they do the same again. They take the whole universe of stocks, divide it into small and big stocks, and then they divide it into low profitability, medium, and high profitability. So, and then they construct the factors in a way, for instance, the book-to-market ratio factor using 2x3 sorts. So they are long on this group plus this group. So taking the average return of this high book-to-market ratio stocks, the average return, and subtract the average return of the low book-to-market ratio groups for these 2 size groups here. So taking the average from here minus the average from here, and that's our book-to-market ratio factor using 2x3 sorts. And the same they do for the other factors as well. Once you have here profitability on the x-axis, you take the average of stocks that have a high profitability and are small and big, minus the average of stocks that have a low profitability, small plus big. And for investment, the other way around. You take the average of small minus of small and big stocks that have a low investment growth minus the average of small and big stocks that have high investment growth. This is 2 by 3 sorts. And for the size factor, they take all the 3 different groups, from sorted by book to market ratio, profitability, and investment, and they take the average of these groups here. This is nine averages, the average across 9 size groups from small stocks for all of these 3 measures. So 3 times 3 is 9, minus the average of these 9 groups, given we have big stocks. That's the S&B factor. And you can play around. You can do 2 by 2 sorts. You can then you have only low and high. You merge this medium group. Then you have 2 by 2 sorts. And you can use 3 by 3 sorts, and so on and so forth. And that's what they talk about on the previous page, as far as I'm concerned. But that's not so important for us. We just focus on the simplest form and also what they actually the data that they provide on the web page, and that's using 2 by 3 sorts, like here. So and here on table 3, they explain basically 2 by 3, 2 by 2, and 2 by 2 by 2 by 2 sorts, and so on and so forth. But that's not so important for us, okay? And you see also very soon why. So table 4 is the next important table in their paper. So here, as I told you, they use 2 by 3 sorts. This is what we're looking at. And they report the sample averages of these risk factors across the sample period. So you see the S&B factor here has a payoff of 0.29. This is you see in panel A, with a t-statistic of 2.31, which means that given the sample period, small stocks generated statistically significantly higher returns than big stocks. You see the HML factor average payoff of 0.37, which is the raw return. What we see here in this table in panel A is the raw return of all the strategies. T-statistic is 3.20, which also indicates statistical significance on even a 1% level. The profitability factor, RMW, robust minus weak, has an average payoff given the sample period of 0.25% per month. T-statistic is 2.92, which also indicates statistical significance on even a 1% level. And we have in the last column here the CMA factor, the investment factor, conservative minus aggressive investing stocks. Generate the spread is an average return 0.33% per month, t-statistic of 4.07, highly significant. Then we see in panel B, they report the correlation matrix using different type of sorts for the S&B factor on the left-hand side. On the right-hand side, you see the same for the HML factor. And what we see, or what we learn from this table is here, they are highly correlated. Whatever sorting we use, they are highly correlated, close to 1. So actually, it doesn't matter what sorting we use. But since we have well-diversified portfolios using 2 by 3 sorts, that's why we consider, in particular, this sorting methodology. In panel C, now we start to get excited here, which may be more interesting. In table C, we see the correlation matrix between these factors, which is quite interesting. So in the paper, in the introduction, they write that the value factor seems to be redundant in their model. So this guy here, the HML factor, does not matter once we account for profitability and investment. And we can implicit, actually, see it here from the correlation matrix, or at least we get some evidence for why this may be so. Yeah. So we see that the correlation between the value factor, HML, and the CMA factor, so the investment factor, is 0.7. What does that mean? Positive correlation means positive covariance, as we Finns say, okay? So that means that the long leg, what's at the long leg of the value strategy? What's in the long leg of HML factor? I just said it. The chance is 50-50. Can be only growth stocks or value stocks. So in the long leg of the HML strategy is of course value stocks. Yeah? And we just explained here that on the long side of the investment strategy are stocks that had a low asset growth. So conservative investing stocks, companies. So this means that value stocks tend to be low investment stocks or companies that have a low asset growth. The correlation is 0.7. So the probability is very high that if we have a value stock, that this stock is low invested or has low investment. This is what it means. And that's also the reason for why we will see very soon that the value factor is redundant once we account for the investment factor here. Let's move to table 5, which is the next important table. So how to read table 5? So let's just consider the left-hand side from table 5. What we see is they use 2x3 factors, as we have explained here, and they use different test portfolios. So now they take their model to the data, the 5-factor model, okay? And they use 25 different test assets in panel A, B, and C. But they sort assets with respect to different characteristics in each panel. So as an alternative, I mean, you might wonder, okay, but why the heck do they use test portfolios? I mean, we have 20,000 stocks or 25,000 stocks, right? But they use only 25 portfolios. Why is that? I mean, this is, of course, a valid claim. You can do this GRS test. You can run this model. It's a multivariate model. You can also use 20,000 stocks if you like. And you can then test like the alpha, the intercept of 25,000 stocks. The problem, if you use stocks are very volatile. That's actually the major problem. So this guy here, this idiosyncratic risk, this firm-specific risk, or portfolio-specific risk becomes very noisy. So they put all of these 25,000 stocks into 25 portfolios. So in each portfolio is roughly 1,000 stocks. So and these are the dependent variables on the left-hand side. And then you put it into a multivariate model, and you have for all of these portfolios, you use the same regressors, which is this 5-factor model. Then you have 25 intercept terms. And I told you that the GRS test basically is a test of sort of the average pricing error of this. If you use 25 stocks, are the alphas on average 0 or not? But we will come back to the GRS test more in detail. So next on Wednesday, I guess. Yeah. So on the left-hand side, you see the GRS test statistic. And I told you earlier, it's actually nothing than an F-test of the intercept terms. So it's nothing fancy going on here. So they do not report in this table here the SMB and the market factor. But all of these regressors here, they account also for the size factor and the market factor. So in the first model, for instance, where they have HML, this means, okay, they use the three-factor model, the SMB factor, the market factor, and the HMM model. In the second row, where it says HML and RMW, that means, okay, they use the size factor, the market factor like before, then the HML factor, and the RMW factor. So this is how you have to read the paper, this table. In the last row, they use all of the factors. Yeah? The last row is actually their five-factor model. And what we see is that the GRS test is lowest for the five-factor model. But the value is the same as if we would neglect the HML factor. So the HML factor doesn't seem to matter if we use 25 test portfolios sorted by size and book-to-market ratio, since the test statistic of the GRS test has the same value, 2.84. Using just the three-factor model, the GRS test has a value of 3.62. So the average pricing error decreases, of course, when we use the five-factor model. Yeah? But I told you already in the beginning, this is not surprising. Because even if you would use some random series here, most likely there would be some correlation just by chance, which would cause the pricing errors to decrease. Yeah. That's the problem. So in panel B, they exchange the test assets. So they use the same stocks, 25,000 stocks. But this time they sort the stocks into portfolios, in the 25 portfolios sorted by size and operating profitability. Yeah. Again, in each portfolio we have about 1,000 stocks, something like that. And then again, in the first row, they report basically the GRS test corresponding to the three-factor model, which has a value of 2.30. What is it? 2.31. Using their five-factor model, and which you see in the last row here of panel B in table 5, GRS test is 1.87. It's lower, of course, compared to the five-factor model. But even if you delete, if you would basically delete this HML factor, the value factor, and if we go to the row before that, it's the same value. It's 1.87. So the GRS test does not improve if we add this HML factor to the model, or if we would just delete it. It would have the same. It would generate the same test statistic or the same average mispricing. This is what we see in panel A and panel B already. The HML factor does not seem to matter, and what we also see is, second point, that the five-factor model prices the test assets better than the old three-factor model. Yeah, and then panel C, they again use, of course, the same stocks, but this time they sort them with respect to size and investment, and then they run the same test again. And again, you see, of course, that the pricing errors are estimated to be the lowest once you use the five-factor model, which is not surprising. And this is now important. All of these models here, they reject the null hypothesis. So under the null hypothesis, the mispricing, the intercept here, is 0. Yeah? So the average mispricing across these 25 test assets that we use is 0. Rejecting the null hypothesis means we have systematic mispricing going on. So this 5-factor model here, exposures, the loadings against these risk factor proxies cannot explain fully the evolution of stock returns. Yeah? So for all of these models, even the 5-factor model here cannot explain the cross-section of expected returns, irrespective of how we sort the stocks into portfolios. The next interesting table is table 6. And what they do in table 6 are factor regressions. Yeah? That's an interesting table. And I also asked this table actually in the exam at some point. Yeah? Just ask the other students who already took the exam. They will tell you. They will tell you. You just have to ask. So what we see here is they use each single risk factor of their 5-factor model here. Yeah? For instance, in the first row, they use the market factor, right? Actually, the second row is more interesting. In the second row, they use the size factor and regress it on all the other factors here. So now the size factor is the dependent variable, and the others are the independent variables. What we see is, after we regress the size factor on all the other risk factors here, the intercept is 0.39% per month with a t-statistic of 3.23, which indicates significance on the 5% level, on the 1% level actually. Yeah, and here we see the loadings of the size factor against the market factor, which is 0.13, with a t-statistic of 4.44. The loading against the HML factor, it's surprisingly 0 or 0.05, but the t-statistic indicates that the size factor, at least as how they have it here, is not correlated with the HML factor, how they have it constructed here, because the t-statistic is 0.81, which indicates it's statistically not different from 0 on the 5% level. But the size factor loads negatively against the RMG factor. What does that mean? That means the long side here, so the long leg of short minus big, so small stocks co-move with the short leg of RMW, and on the short side of the profitability factor are stocks that are unprofitable. So small stocks tend to be stocks that are not profitable. Yeah. So because the intercept here indicates that the other risk factors here in their model cannot explain the size spread, so that's why we can conclude the size matters. Size as a risk factor matters because the other risk factors cannot explain it. Next, HMW. Next, we grab the value factor of this equation, use it as a dependent variable, and regress it on the size factor, the profitability factor, and the investment factor. These are now our regressors. And of course the market factor. Yeah, this is always there. The market factor is always there. We can't get rid of it. So what we see here, and that's now interesting. Yeah? So the intercept, after we regress the value factor on all the other factors, we see the intercept is statistically not different from 0. It's negative 0.04, and the t-statistic is minus 0.47, which indicates it's statistically not different from 0. There is no value premium anymore once we control for the other risk factors. the evolution of the value spread is fully explained by its loadings against the other risk factors. And it's obvious. Yeah? If we move here, for instance, the loading of the value spread against the profitability factor is positive 0.23 with a t statistic of 5.36, which indicates significance on a common level, and which also means that the positive leg, the positive side of value of HMA, which is value stocks, co-move with the long side of this profitability strategy. So value stocks tend to be stocks that are profitable, and moreover, they tend to be stocks that are low investment stocks. Value stocks tend to be stocks that are low investment stocks because the loading against the investment factor is 1.04 with t statistic of 23.03. So it's highly significant. And this 1 here, this is almost 1.00. 1.04 is almost like 1. Okay, we can say it's 1. So it moves 1 by 1. It moves 1 by 1 with the investment factor. If the investment factor moves up 1%, value stocks move up 1%. Same direction. Spread. So this regression model, so if we regress the value spread on the other risk factors, we can explain 0.51, 51% of the variation of values of the value factor can be explained by the other regressors here in this model, which is quite much. Yeah. So, and that's here the problem. Well, that's basically the point, the key point. Yeah. That the value stocks basically, because they co-move so much, they are so highly correlated with the CMA factor, in particular the long legs of both strategies, at the long legs, because it's positive correlation. That's why the value factor seems to be redundant in the 5-factor asset pricing model. Yeah? We can skip it. Then we see finally here RMW and CMA. So they do the same thing. You can look at that at home. Yeah, we do the same thing. We grab then the profitability factor and regress it on the others. And then finally we take the CMA factor and regress it on the others. But we see the intercepts are statistically positive and significant, yeah, as we might expect. So for me, it's important that you understand how to interpret the loadings. Yeah. Because next we will go and interpret, or we will try to figure out, okay, what portfolios are actually the most troublesome for why this 5-factor model fails in pricing the cross-section of expected returns. There's a reason for that, and we want to know what are the troublesome portfolios, what are the troublesome stocks, what characteristics do they have. And we will use the 5-factor model to price the stocks, and we will compare it to the 3-factor model. But depending on the loadings against the risk factors, we know what stocks are in these portfolios. We know the characteristics. We can read it from the loadings. Any questions? Everything is crystal clear? So far, so good. So, that's an important table. I usually ask this in one of the 3 exams. There's one question for that table. Yeah? So write it down.
Is this why it will be table 6 and table 7 will be in the exam?
Well, at least in one of the exams. Yeah, it depends on which exam you attend. So maybe you're lucky. So table 7. So again, I told you earlier, we could use the whole universe of NYSE stocks, 25,000 stocks, but no one does that. So again, we use different types of test assets sorted with respect to different characteristics. Here in table 7, we use 25 value-weighted portfolios sorted by size and book-to-market ratio. And by the way, why do we use value-weighted portfolios? We are talking about that already last week. Why do we use value-weighted portfolios? Why don't we use equal weighted portfolios? Well, we use value-weighted portfolios because we want to pay more attention to stocks that have a high market capitalization. Yeah? Most cross-sectional patterns are more pronounced if we use small stocks, and they might give a wrong impression if we would run this pricing test using equal-weighted stocks. It might give a wrong impression because the results may be driven from stocks that are too small, from microcaps. But we want to give microcaps only little attention. Yeah? Microcaps get a low weight because they have a low market capitalization, but big stocks get a bigger weight here, depending on the market capitalization at time t. So again, we use 25 value-weighted portfolios sorted by size and book-to-market ratio. Sample period is from 63 to 2013, 606 months as before. So we see here in panel A, we see the alphas, the pricing errors, using the 3-factor model as reference model. Yeah? So for instance, the portfolio that has small stocks and growth stocks, in essence, stocks that have a low book-to-market ratio, have an average pricing error, a mispricing of minus 0.49 using the 3-factor model. And this mispricing is significantly, because we see that here statistic is minus 5.18, which indicates significance on any level. Okay? Bad mispricing. And we can see, if we just have a look on the right-hand side of panel A in table 5, we see the t-statistic reported for all of these estimated alphas that we see on the left-hand side. Yeah? And we see there are 7 significant alphas. So we can basically count those t-statistics that are above 1.96 or below 1.96, because this indicates, okay, these mispricings here are significant. This means, okay, using the 3-factor model, there are 7 test assets that cannot be priced because the alphas are too high or too low. Okay, then we move to panel B. In panel B, they report the intercepts of these 25 test assets using the 5-factor model here. What do we see here? Again, the small stock portfolio, small stock and growth stocks, they generate minus 0.29% per month mispricing. Okay, and the t-statistic is here reported on the right-hand side is minus 3.31. It's lower, or it's a little bit better. It has improved compared to the 3-factor model, since there we had a t-statistic of minus 5.18 and the mispricing was much higher. It was minus 0.49, now it's minus 0.29. So the mispricing has decreased in economic magnitude, but it's still significant on the 5% level, even on the 1% level. And if we count the number of significant t-statistics, which we see here on the right-hand side of panel B, then we see there are still 5 portfolios that the Fama and Friends 5-factor model cannot price, since the t-statistics indicate that we have here 5 intercepts going on the left-hand side that the 5-factor model cannot explain. And now it's the question, okay, What are the characteristics? We know this portfolio here consists of small stocks that have a low book-to-market ratio, so growth stocks that are small. But what else can we read using this model here? Now we have to investigate, okay, what are the loadings against the profitability factor and against the investment factor? Once we know the loadings, we know how they invest. Okay, this is here redundant, yeah, because this reports the loading against the HML factor, but we know already that we are in the growth, that we use growth stocks, right? So of course the point estimate here against the HML factor must be negative, and it's significantly negative. Point estimate is minus 0.43, T statistic is minus 10.11, so highly significantly negative, so highly invested in growth stocks. But it's not surprising because we already used this portfolio where we know ex ante, okay, we have small stocks and growth stocks, okay? So that's not surprising, okay. Next one, we have the loading against the profitability factor. Yeah, now we are here, the Novimax factor. So we see the loading, the beta, is minus 0.58 of this portfolio here that makes troubles. Yeah? So minus 0.58, what does that mean? Are the stocks profitable or not profitable? The chance is 50-50 if you don't know the answer. Who is brave? So minus 0.58. It means that the long leg of our strategy, of this portfolio, co-moves with the short leg of the RMW, which is invested in weak stocks. The short leg is invested in weak stocks, so that have a low profitability. So this portfolio of small growth stocks that causes troubles are not profitable. Next, we see the loading against the investment factor. The loading is also negative, minus 0.58, same economic magnitude basically like the loading against the profitability factor. So minus 0.58, loading against the investment factor, T statistic of minus 12, so highly significant. What does that mean? Again, it co-moves with the negative loading implies it co-moves with the short side of the CMA factor. What's in the short side of the CMA factor, of the investment factor? It's like, yes, thank you, kiitos, as we say in Finland, yes. So these are stocks that invest aggressively. They have a high asset growth. So these stocks are small stocks that are growth stocks that are not profitable but investing a lot. It doesn't make much of a sense, right? That doesn't seem to be rational, right? You have a company that is not profitable and small, but still you invest a lot. Of course, that makes troubles. I mean, it's obvious, and we see it in the data. Yeah? And the other portfolios, here, the second one, the mispricing is only marginal significant here. You see it's minus 1.73, which is significant on a 10% level, but not on a 5% level. But this is obviously portfolios, or this is obviously one portfolio that causes enormous troubles for this 5-factor model. And this is also actually what they write in their paper. And you can read it from the table. Yeah. So these firms behave so weird that not even this model can explain it. Yeah. And well, if we move back here on to panel B, to the left-hand side of panel B, where we have the estimated intercepts reported, and there are also other portfolios where we see a mispricing going on here. So now in the exam, for instance, I could ask you, okay, what about this portfolio here. Small stocks that have a high book-to-market ratio. Point estimate 0.12. T-statistic is 1.99, which means the mispricing is statistically significant on a 5% level. What's going on here? I could write in the exam, what's going on here? Then you can write an essay. What you think, how you feel. Okay, maybe not how you feel, but I mean at least your opinion about that, okay? So then you can read basically the characteristics from the loadings here, from the loading against the profitability factor and from the loading against the investment factor. Then you have to know, of course, what does the positive loading mean and what does the negative loading mean. And we discussed it already a dozen of times here in this course. Okay? Is this clear to everybody? How you interpret this table and what's going on. Okay, this is what you basically need to do, and I know if you work, later on, most likely you will also work with data. Most likely. I think that's it. That's pretty much what you will be supposed to do. And in your own interest, there's a market report, a research report from McKinsey. And they make a forecast. Actually, you can download it in the internet. I didn't write it in the student guide because I didn't want to scare you too much. But first I was thinking about, okay, maybe I should report that as well. But well, they make a market report and they make a forecast on how, for instance, unemployment will evolve over time. So the issue is that we, in the next, like say, 10, 15 years, technology has advanced a lot, and the industry has already the technology to rationalize away about 30% of the labor force. So, which means because technology is advancing, there will be less and less jobs available to people. So more and more things will be done by programs. For instance, if you run a fund manager, I was talking like last year with one guy who was affiliated with Robeco, I think it was Robeco, this investment fund in Luxembourg. Was in Luxembourg, I don't remember. But he was telling me basically, okay, it is not any longer like that you have that each investment fund has one fund manager. It is not working like that anymore. So there's one guy who writes investment strategy. Yeah, he's coding the stuff, like one analyst, and he does that for 10 or 15 different funds. Okay, this is one guy who does the job for 10 or 15 different mutual funds. It's automated process. They run the strategies here and it's automated, and then sometimes they improve the code and the investment and so on and so forth. It's of course adjusted from time to time, but you don't need 20 people to do that, you need one guy. So that's one thing. So the number of good jobs is decreasing over time, that's for sure, because of technology. So on the other side, the population on Earth is increasing still. Maybe not in Finland, okay, this is other problems, but from other countries, the population is increasing, okay? So there are more and more people coming, they get better and better educated, and they want to do the same thing what you want to do. You have to compete with these people for less jobs, okay? Research report from McKinsey. I mean, you can read it. I don't want to scare you, I just want to tell you how real life looks like, and that's some things, you have to do. I mean, I know people, like they come from high school, like 20 years old, 21, and what they do after school, they start to sing. There are millions of songs in the internet, on YouTube, and who cares? No one is interested in that, okay? You cannot earn money with that. You have to do something that the industry needs, You have to, if you want to survive, you have to do something that is needed for society and for the industry. And nowadays, the industry looks for people who can handle data, because we have so much data and they want to optimize working processes and so on and so forth. So they need people who can operate with data. So if you want to have a good job, or want to have a good life, if you want to survive, you have to do something that ensures your survival. So that's my thought, yeah. But you can read the research report from McKinsey by yourself if you want. You can just Google it. Let's move to table 8. You can skip. It's not important. At least not for me, not for this course. Table 9 is more interesting. And this also the last table is interesting. And we'll only discuss it very briefly. So they do basically the same thing again, but now they use 25 stocks as portfolios, yeah, sorted by size, but now operating profitability as well, and not book-to-market ratio that we had in the previous table. Yeah. So again, we have 25 portfolios, and again, they report in panel A the corresponding intercepts of the 3-factor model that they use as a reference model. Yeah. And in panel B, they report the 5-factor alphas, yeah, the intercepts for these 25 portfolios using the 5-factor model. Yeah. Again, on the right-hand side, you see the corresponding T statistics. And you see here on this table, or from this table, the major takeaway is, okay, the 3-factor model is not able to price 8 of these 25 portfolios sorted by size and operating profitability, whereas the 5-factor model is able to price 23 out of 25, which is a quite good job. Okay? There are only 2 pricing errors here, 0.14 and minus 0.15, which have T statistics that indicate statistical significant mispricing. But all the others are all right. And then you can do the same thing again. You can go, of course, I could ask, okay, look at these stocks and tell me about the characteristics. And then you can read them here from the loadings against the profitability factor and the loading against the investment factor. Yeah, and what you see here is, you know, this troublesome portfolio, what we had here on in the first column, the last entry, the loading is not significant against the CMA factor, so we cannot say that this portfolio consists of stocks that are either too conservative or too aggressive invested. It's neutral. The loading is statistically not different from 0, so it doesn't load on this factor here. That means it's equally invested in stocks or in companies that are aggressively or conservatively invested. So it's on average, it's like 0. That's how you would interpret this table here, okay? So the conclusions, you can read it, of course. I mean, you know, they don't, interesting for me when I read the paper was, okay, they write, okay, they don't report the R squared. Why not? Why wouldn't you do that? I mean, at least I was wondering, okay, why wouldn't they do it? But of course I know it, because the R square most likely will not improve so much, even though you have here 2 more factors. Because even if you would have some random factors that have some random correlation with the other factors, or with the test assets here, you would have a higher R square, purely by chance. So these 2 factors here do not add so much in terms of explained or of explained variation, but at least they do a good job in decreasing the overall average mispricing. All right, that's it. If you have any questions, feel free. Otherwise, I guess I see you then on Wednesday.